Every single move in the Bitcoin market leaves clues behind, and those clues appear in something called candlestick charts. Once you understand how to read them, the market starts telling a story most beginners completely miss.
Imagine opening a crypto chart for the first time and realizing that every tiny candle on the screen is actually a story about fear, greed, patience, and opportunity playing out in real time. Because that's exactly what a candlestick chart is. A visual language that traders use to understand what the market is thinking. When you first look at crypto candles, they might seem random, just little green and red bars moving up and down. But once you learn how to read them, you start to see patterns, clues, and signals that can help you anticipate where price might move next. Each candle represents price action over a specific period of time, whether that's 1 minute, 5 minutes, 1 hour, or 1 day. And every candle has 4 key pieces of information hidden inside it. The opening price, the closing price, the highest price during that time, and the lowest price during that time. The thick part of the candle, called the body, shows the difference between the open and the close, while the thin lines above and below, known as wicks or shadows, show how far price moved beyond those levels before pulling back. When the candle is green, it means the price closed higher than it opened, which usually signals buying pressure. And when the candle is red, it means the price closed lower than it opened, signaling selling pressure. But the real magic of candlestick reading isn't just knowing what green and red mean, it's understanding the story that groups of candles tell when they form patterns on the chart. For example, imagine the market has been falling for hours and suddenly you see a candle with a tiny body and a long lower wick, which means sellers pushed the price down hard but buyers stepped in and forced the price back up before the candle closed. This type of candle is often called a hammer, and it can signal that selling momentum is weakening and buyers may be preparing to take control. On the other hand, if the market has been climbing and you suddenly see a candle with a long upper wick and a small body near the bottom, that can be a sign that buyers tried to push higher but were rejected by strong sellers, which may signal that a reversal or pullback is coming. The key idea here is that candles reveal the battle between buyers and sellers, and by watching how that battle plays out over multiple candles, you start to recognize when one side is gaining strength. One of the most powerful concepts in candlestick trading is momentum, which simply means how strong a move is in one direction, and you can often see momentum by looking at the size of candle bodies. When candles are large and consistently closing near their highs during an uptrend, that usually means buyers are confident and aggressive, pushing the price higher with little resistance. But when candle bodies start shrinking and wicks begin appearing on both sides, it often means the market is losing conviction and may be preparing for a change in direction. Another powerful signal comes from what traders call engulfing candles, which happen when a new candle completely covers the body of the previous candle. A bullish engulfing pattern occurs when a red candle is followed by a strong green candle that opens lower but closes higher than the previous candle's open, essentially swallowing it, and this can signal that buyers have suddenly taken control of the market. A bearish engulfing pattern is the opposite, a green candle followed by a larger red candle that overtakes it, suggesting sellers may be about to push prices down. When you combine these patterns with support and resistance levels, your ability to predict market moves becomes much stronger. Support is a price level where the market has historically found buyers who are willing to step in and prevent the price from falling further, while resistance is a level where sellers tend to appear and stop the price from rising higher. When a bullish candle pattern forms at support, it often signals that the market may bounce upward, and when a bearish pattern forms at resistance, it can signal a potential drop. This is why experienced traders rarely look at candles in isolation. They look at where those candles appear on the chart and what the broader trend is doing. Trends themselves are another major clue hidden inside candlestick charts, because markets tend to move in waves rather than straight lines, forming higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend. When you start recognizing these structures, you can use candles to time entries and exits within those trends. For example, during a strong uptrend, the smartest strategy often isn't chasing the price when it's already soaring upward, but waiting patiently for a pullback toward a support level and then watching for bullish candles that signal buyers stepping back in. That moment, when a pullback ends and momentum begins again, is where many of the best trading opportunities appear. Volume can also add another layer of insight to candlestick analysis because it tells you how much activity is behind a price move. A large bullish candle accompanied by strong volume usually indicates genuine buying interest and may lead to continued movement, while a big candle with very low volume can sometimes signal a weak move that may not last. Over time, as you watch thousands of candles form, you begin to develop an instinct for market behavior. You'll start noticing when a trend feels healthy, when it feels exhausted, and when the market is quietly building energy for a breakout. Breakouts themselves are another exciting moment in candlestick trading because they occur when price finally breaks through a well-established support or resistance level, often leading to rapid movement as traders rush to enter positions. A breakout accompanied by a strong candle closing decisively beyond resistance can signal the beginning of a new upward trend, while a breakdown below support can indicate the start of a downward move. However, not every breakout is real, and this is where patience becomes one of the most valuable skills a trader can develop. Sometimes the market will briefly push beyond a level only to reverse immediately, creating what traders call a false breakout or fake out. Watching how candles behave after a breakout attempt can help you avoid these traps. Strong follow-through candles usually confirm the move, while weak candles with long wicks may signal rejection. Another fascinating aspect of candlestick reading is understanding market psychology. Every candle represents thousands or even millions of individual decisions made by traders around the world, each one reacting to news, emotions, and expectations about the future. When fear dominates the market, candles often become long and red as traders rush to sell, but when confidence returns, you'll start seeing strong green candles that climb steadily upward. Recognizing these emotional shifts can help you stay one step ahead, because markets often turn when the majority of traders least expect it. This is why many successful traders focus not only on the candles themselves but also on the context surrounding them. The trend, the volume, the support and resistance levels, and the broader market sentiment. As you practice reading candles, you'll begin to notice that certain patterns repeat again and again across different time frames and different cryptocurrencies. Because human psychology doesn't really change even though the assets do. Bitcoin, Ethereum, and countless other coins all follow the same fundamental patterns of accumulation, breakout, trend, exhaustion, and reversal. The more time you spend studying these patterns, the more intuitive they become, almost like learning a new language where each candle is a word and each group of candles forms a sentence describing what the market is doing. Eventually, you'll reach a point where you can glance at a chart and quickly recognize whether buyers or sellers currently have the advantage. That doesn't mean you'll predict every move perfectly, because no trader can do that, but it does mean you'll be making decisions based on evidence rather than guessing. The goal of learning candlestick analysis isn't to achieve perfect predictions. It's to stack probabilities in your favor so that over many trades your wins outweigh your losses. Risk management remains essential because even the strongest candlestick signal can fail, which is why disciplined traders always plan their exits and never risk more than they can afford to lose. But when you combine solid risk management with a deep understanding of candlestick patterns, support and resistance, trend structure, and market psychology, you begin to transform from someone who simply watches the market into someone who can interpret it. The next time you open a crypto chart and see those rows of red and green candles flickering across the screen, remember that they're not random shapes. They're the footprints of millions of decisions, the echoes of battles between buyers and sellers, and the clues that reveal where the market might move next for those patient enough to read the story they're telling.